Welcome to Taking Stock, Empower's first thoughts on leading financial news. Today, we're talking about the Fed's final rate decision of the year. As expected, the central bank cut rates by 1/4 percentage point, marking the third consecutive rate cut of 2024. The Fed is also now forecasting fewer cuts for next year, and the market is selling off. Marta, Norton, Empower's chief investment strategist, is with me now to explain why. Marta, rare for us to be in the same city on a Fed decision day.
Yes.
So good to see you here at Empower's headquarters in Denver. Let's get right to it. We know that this 1/4 percentage point cut was largely expected, but I think the real story here lies in what it signals for 2025. So based on what you heard from Chair Powell today, what can we expect from the Fed next year?
Okay, so there is a pivot here. In September, the Fed released its summary of economic projections and put in about 4 cuts over the course of 2025. We got a new summary of economic projections today, and we see just 2 cuts penciled in for 2025. And that's largely because growth has been stronger than anticipated. The labor market has been more stable than anticipated. And we've also seen inflation prove a little bit stickier than anticipated. And of course, we're also seeing rates getting closer to that neutral rate, which is the interest rate that neither stimulates nor restricts the economy.
This mostly seems like good news. So why is the market selling off?
Right. The market is down meaningfully. And I think that really points to what investors were anticipating being drivers of the market as we move into 2025. And a big part of that was lower interest rates. And if the Fed is projecting a slower pace of interest rate cuts, that removes one of the stimulants for the market.
Makes sense. One of the things that we were looking for, and a lot of people were talking about this, was would the Fed incorporate some considerations for Trump administration policies? Did you hear any hints of that today?
You know, interestingly enough, we did hear something around that in the press conference itself. So what Powell has said is that the Fed isn't going to speculate on what Trump policy is going to be and adjust its policy accordingly, adjust rates accordingly. But what Powell did point to was in the summary of economic projections, a few Fed officials did acknowledge that they were playing around with their projections according to what policies were meant to be. Now, Powell continues to say that there's uncertainty there, and the farther they're going today is to really think through kind of the theoretical or empirical impact of, say, tariffs on inflation.
It's still a wait and see approach.
Still wait and see.
Let's talk about the consumer impact here, because we know that there are both borrowing cost considerations and also savings considerations.
That's right. And when we talk about higher interest rates, one of the things we focus on, and maybe the market is focused on today, is the negatives and the impact on the economy. But there are some positives there. When you have higher interest rates, particularly at the short end, that can boost the yields on cash-like investments. And so that can be a positive thing for savers. Now, on the side of the borrowers, a lot of consumer loans key off the longer end of the curve. So yes, Fed rate policy impacts them, but there are other variables that play too. And what I would say on an overarching standpoint is I think the market and investors are coming to grips with the possibility that we could see higher short-term rates and higher long-term rates than maybe people had anticipated.
Anything else, Marta, jump out to you today in the announcement and then Powell's news conference that followed? Because I know that you've been pointing to a stronger economy than the Fed was predicting back in September, and that seemed to be a theme that we heard over and over today.
We did hear that theme repeatedly throughout the press conference. It was interesting to hear Powell acknowledge both the strength of the economy and the strength of the labor market, which is something, to your point, that we've been pointing to since September, when the Fed seemed particularly unnerved by the recent labor numbers at that point in time. What was also a surprise to me was the inflation narrative that Powell put out there. Now, Powell specifically said that inflation has been hotter or maybe stickier than anticipated by the Fed. Now, he says that a lot of the drivers they've been pointing to remain in play. They remain confident that inflation is going to make its way back to their 2% target, but that the timing is especially tricky, underscoring that trickiness there. And I think at some point that timing does matter. And then one last point I would make is just the reaction from the market is so severe. It really does suggest that the market was confident that rates were coming down and that was going to fuel economic activity and market returns.
Yeah, as we've seen today, the economy has been full of surprises, even for the experts.
That's right.
Great insights as always, Marta. Thank you so much. And big thanks to all of you for watching Taking Stock. Have a great rest of the week. We'll see you back here again soon.